Pero yo lo fui a ver.
Siempre el área.
¿Qué tal? ¿Qué tenemos? El lunes, pero mañana también. Mañana. Let's wait a couple of minutes. And some people will be connected, I think. So maybe not. No, pero sí. I had to teach this morning, so I send you the agenda just now. Sorry. Sto facturando tipo tenemos que ver a Guatemala. Guatemala. Sí. Que si viene Sofía. No, deberías conectar. Ah, verdad que me iba a venir. Esta semana. Sí, las cosas. ¿Tú qué cuántos va? So let's wait a couple of minutes. So, and then we should start something. No ha llegado nadie del DF. Está con el licón. Todos.
Todos, todo el rato. Todos los días. No lo sé.
Okay, probably we should start. So today we have the pleasure to have Paul Fontanier from Yale SOM. We'll talk about dollar debt and an efficient global financial cycle. You have up to 1 p.m. all included. Take it away.
Thank you. Thank you so much to everyone for being here and for inviting me to give this. I'm also going to be around tomorrow, so if anyone wants to talk more, I will be there. Okay, so the title is Dollar Debt and the Inefficient Global Financial Cycle. And the contribution of the paper is really in the word inefficient here. Okay, so it's going to be a paper about optimal policy and the spillovers associated with optimal policy in emerging markets. Okay, so the starting point is the global financial cycle. So what do I mean by the global financial cycle here? I simply mean the fact that there is a global and very strong movement between many different global variables, such as prices, credit, capital flows, and even policy rates across countries. And one of the most striking facts about the global financial cycle is that it seems that it's largely driven by US monetary shocks. What do I mean by that? I mean, when the Fed tightens, you do see a retrenchment of capital flows out of the emerging markets to the rest of the world, a contraction in global credit, falling asset prices, and so on. So one of the reasons that has been given for the existence of this cycle, not the only one, but the one I'm going to take in that paper and I'm going to use as a building block, is the fact that a lot of corporations, especially in emerging markets, issue debt denominated in foreign currencies, and usually in the dollar, which means that when the Fed tightens, that creates depreciation of currencies automatically. And so if these firms are currency mismatched, they issue debt in dollars, but the revenues are in local currency, most of it, and they're not fully hedged, then that depreciation is costly because it's simply more expensive to reimburse the debt. And so if you couple that with some type of financial friction that are binding at the firm level, this is going to be costly in terms of investment, output, employment, and so on and so on. Okay, so if you have this balance sheet effect, that explains part of why the global financial cycle is costly, especially in emerging markets. Okay, so these are the facts. Now, this is also the reason why you might see something that seems to be there in the data, even though it's debated, but I don't really need that for the paper, but we can talk more about this, is the fact that you have a synchronized policy response across countries. So the idea here is that when the Fed tightens, like corporations issue debt in dollars, it's costly for them to reimburse their debt, so they have to cut on investment and output. The one thing I can do to try to help them is to fight the depreciation of the currency, because that's the root cause of the problem here. And one way to do this is to raise my interest rates, or at least not lower it as much as I would like to if I were not facing this problem at the same time. So that's why you might see something like when the US raised the interest rate, the monetary policy stance in all of these emerging markets is going to be tighter than what would be needed if they were just going to focus on purely aggregate management in their own country. Okay. Now, this is something that a debate that came out, especially during the tapering tantrum episode, and one of the reasons is the following. So if you take a group of, I don't know if it's 14 or 16 emerging markets here, and you classify them in two groups, for the ones that have a level of reserves that is above capital adequacy as defined by the IMF, or below capital adequacy, what you see is that when Bernanke suggests that they would taper long-term asset purchasing, so signaling a more restrictive US monetary policy stance in the future, you see a divergence of monetary policies in these two groups of countries. So basically, if you have enough reserves on the balance sheet of your central bank and you can defend your currency, you don't see a tightening of local monetary policy in this country. But if you don't have enough reserve, and basically that's the interpretation I have here, the interest rate is the only thing you have at your disposal to try to defend your currency, then you might have to increase your monetary policy and incur some costs, at least in terms of aggregate demand in exterior. Okay, now, the striking figure here is that this is not just one country, it's multiple countries at the same time. And so the question I want to face here in that paper is what happens if you do have this synchronized policy response across emerging markets, and whether there is some potential for spillovers in these optimal responses. Okay, but the way I'm going to do this is that just take the perspective first of a central banker in one emerging market that faces this global financial cycle for the reasons I just highlighted before. And then once you go from one country and its optimal monetary policy response, taking into account what's happening in the rest of the world, what's happening if you have multiple countries trying to do the same thing at the same time? What is the role of capital flows in such a setup in generating potential spillovers between these emerging markets? Again, that's going to be the key result of the paper, and to give you the conditions under which you get this type of spillovers across emerging markets. If you have spillovers, then probably there is a need for coordination. Coordination can help you get away from these spillovers. That's going to be another corollary of these results. The nice thing about doing this in the setup of this dollar debt problem, of this currency mismatch, is that then you can also study optimal ex-ante policy. So not just how should I respond to changes in the level of my currency because the Fed does something, but also ex-ante, knowing that I'm going to have a problem and potentially spillovers between these emerging markets if the Fed does something. Is there an optimal macroprudential policy that I could put in place that would be privately optimal and that would get me away from this? That's what you get from studying the problem. Yes.
What are the channels of these spillovers? Is it capital flows? Is it exchange rate or trade or?
So depends what you mean by channel. The channel is going to be capital flows going through the balance sheet of the intermediary. I'm going to be very precise about this because that's the key result of the paper. Capital flows being intermediated by intermediaries, having a feedback effect on the level of exchange rates, and that's a spillover effect. It's not just capital flows move because I change my monetary policy stance. It has an impact on the exchange rate of other countries through capital flows intermediated by the balance sheet of intermediaries. So there's multiple steps in the argument, but I'm going to show you it. Hopefully it's going to be.
Well, can you show the picture again? The one you just showed?
Yeah.
So the motivation there is that for that group of countries, you basically have a contractionary response to monetary policy.
Yeah.
But it's what we talked yesterday, no? How does this speak about the evidence of the Lido and Gopinath and Chenne, where they document the opposite, no? Like emerging markets actually floated, though they on average response expansionary in an expansionary way to US contractions.
Yes. So
this is like a case study for the
yeah, that's a case study, and the taper tantrum is very clear because you get this divergence in two different directions.
Mm-hmm.
In the general case that the paper you're mentioning that we talked about yesterday, so that everyone's on the same page, the paper that shows that when there is a US monetary policy shock, what you actually see on average in emerging markets is central banks lowering the interest rate to try to stimulate the economy. And I think and so this is not what I need for the paper. What I need is the fact that your monetary policy stance is less accommodative than what you would ideally like if you are not facing problems on the balance sheet of the corporation. So in a sense, and that's something you cannot see in the data, right? The question is not, are you tightening or loosening in response to the Fed? Is how constrained are you in your monetary policy response? So in a sense, what you would like to see in the data from the paper you mentioned is something like, I do two groups of countries, the ones that are really facing the dollar debt issues and the ones that are not, and I should see the ones that are not facing dollar debt problems loosening more than the others. And that's an indication that you still get a divergence of monetary policy. So in a sense, the interpretation here is that these countries, maybe the optimal response is to loosen a lot. They cannot completely target aggregate demand. They do have to defend their currencies in some way. And so they end up in the middle of it. So I'm going to show you an extension at the end if I have time, where you don't get the tightening in response to the US increasing the interest rate. You do get the loosening. That's because there is an aggregate demand shock at the same time. So I'm trying to close that aggregate demand gap, but I cannot go all the way to closing it, because if I do this, my currency is going to be very depreciated, and that's going to be very costly for my corporation. And so I end up in the middle. So it's still a accommodative response, and I still get exactly the same kind of spillovers as the ones that are here. But I'm going to show you why that's the case. So for simplicity here during the main part of the talk, it's going to look like this, because there's going to be only one thing you respond to, the Fed shock. Okay. But then at the end, I show you that the same thing happens if you add something more complicated and you get the same kind of. It's just less clear to see what's happening when that's the case, but you actually don't need that response. Yes, that's a very good point. Okay, so the way I'm going to do this is the following. So start with a very stylized and tractable model of just one small open economy, where you have entrepreneurs that borrow in dollars and in local currency. And then you have two frictions. The first is nominal rigidity friction, and here in that model is going to be fully rigid wages for simplicity. So if you stop here, what the role of the central bank is just you set the interest rate at the natural rate of interest such that you close the output gap, and so you don't have anything else to do, and that's the end of your job. So of course, you have the second friction, so that there's a meaningful trade-off here for the central bank, and that's going to be a financial friction at the level of these entrepreneurs that in the past borrowed in dollars and in local currency. And that's going to give you the trade-off between aggregate demand from the side of household because of rigid wages and balance sheet effects on the side of entrepreneurs, and you have to be kind of in the middle of the two. Okay, so that's the first step. Here, I just want to highlight, this is not a new result, right? What is the optimal monetary policy response in a small open economy that faces this trade-off? This is something that we know at least since this paper, right, in 2004. What I do want to highlight is that I'm going to do it in a very easy and tractable way, so that when you take that model and you go to a set of emerging markets that face the same problem, you can still analyze in close form what's happening in terms of optimal monetary policy. Okay, so small open economy first, then a set of these identical countries for simplicity. But then I'm going to add a layer of intermediation, and that is in the spirit of the Gabex and Marjorie friction. I'm going to be more precise about this in the talk, but type of friction that everyone uses in these models now. But basically, the equilibrium is determined also by the size of the flows that you're trying to send to the rest of the world or receive to the rest of the world. Matters for the determination of the interest rate and the exchange rate. That's the idea here. Okay. So this arbitrage in the middle is going to intermediate capital flows from this set of emerging markets to the rest of the world, and the size of the flows is going to determine the premium on that rate. Okay, that's going to be very crucial because that's where the spillovers are actually going to come from. And then in each of these countries, there is a central bank that for now is doing only one thing, which is deciding on the level of the nominal interest rate, so just one instrument, okay, for simplicity. No access to something else for now. And then at the end, I hope to have time to talk about it. What happens if you have access to something else in the form of macroprudential policy? So can you influence the first step here? How much entrepreneurs borrow in dollars versus local currency, and can that help you achieve a better equilibrium? And then what happens if you have access to foreign exchange interventions? You can not only use the interest rate to target these two things, you can also use something else, which is the use of reserves to help you. But that's going to be at the end. Okay, so what are the results? So first, what is the result when you have only one small open economy? So again, not a new set of results, something we know from before, but just I'm going to reiterate that this is done in what I think is a very tractable and nice way. So the central bank is stuck in a dilemma between two things. There is aggregate demand and there is balance sheet effects. And so you're going to end up in the middle. So why are these two things in contradiction? Simply because if you want to stimulate aggregate demand, you need to lower the interest rate. But if you do this, you depreciate the exchange rate. So you make it more expensive for your firms to reimburse their debt in dollars since their revenues are in local currency. And so they're against the financial friction. And so they're going to lower their level of investment and future output, which is going to be costly. And so that's why you need to trade off the two. You have only one instrument, the interest rate, but these two forces are going in opposite direction. And so that's why. Okay. Now, depending on the size of the aggregate demand shock, the size of the dollar shock that triggers these balance sheet effects, you might end up being more accommodative or more restrictive, from an absolute point of view. But the results still stand in the sense that there is a trade-off between the two. Okay. So of course, because there is a trade-off, you end up not fully closing the output gap, since you have to take the balance sheet effects at the same time. And so in equilibrium, when these shocks are large enough, you're going to have involuntary unemployment, in the sense that you would like, if you didn't face this exchange rate problem, you would like to stimulate the economy more to get rid of involuntary unemployment, but you cannot, and so you also have that. At the same time, in this model, the two things are the same, just because there is fully rigid rate. Okay, and so you get this very, easy model of the global financial cycle, where when the Fed tightens, you kind of have to respond to that movement in the interest rate because you have to respond to movements in your currencies because of the balance sheet effects, and it's costly. It's not just like a global co-movement between these variables. It is costly in terms of welfare because I have to allow for some type of output gap in my model because of this trade-off between these two. Okay, so that's the model of the global financial cycle in a very tractable way. Now, what is the main result of the paper is this point number 2 here, which is if you have that type of global financial cycle and your global markets are frictional in the sense of the Gabex and Marjorie type of intermediation that is very prominent in this type of models now, then this cycle is inefficient in the sense that the monetary policy response in each of these different countries is excessively volatile. So each one of these central banks is not going to take into account that by responding optimally from their product perspective to this movement in the Fed rate, to these dollar shocks, they're going to seek to attract capital flows at the expense of the other country that's next door that's going through the same intermediary. And that's going to be costly in the form of what I call a bottleneck externality here. And the reason is going to be because you're going to see that there is a bottleneck effect at the level of the balance sheet of this intermediary. So all of these central banks, let's take the case for, Mexico, Peru, and Brazil, trying to appreciate their currency at the same time to lessen the effects of these balance sheet effects here. By doing this, they attract more capital flows, which means that the intermediary needs to intermediate a larger set of capital flows for these three countries. They need to expand their balance sheet, and that's going to be costly for frictional reasons or regulation reasons. And so they're going to require a higher premium for intermediating this capital flow. Higher premium like this translates into basically a higher interest rate on your external interest rate that you can have on dollar savings or borrowing. And that acts exactly as a UIP force for depreciating your own currency. So that's why you get a feedback effect through the exchange rate. Okay? So it's not capital flows per se that are costly, it's the fact that by asking the intermediary to intermediate more capital flows, they need to be compensated for that expanding the size of the balance sheet. That translates into a higher external interest rate, and that translates into a depreciation of the exchange rate for everyone. And that is costly because of this balance sheet. So, okay, so you need all of these steps to get to the externality. Yes.
Is there any role for the exports of these small open economies? Because that's going to also lessen this trade-off, right? Because it's like if you have a large sector that can benefit from not appreciating your currency so much or even depreciating it, then this kind of trade-off is lessened?
Yes, so that because I really want to highlight just that trade-off, I'm going to kill that force.
Okay.
And the reason I'm going to kill it, the way I'm going to kill it is just assuming that tradable is endowments and not produced, and so you don't get that effect on exports and imports. Okay. Then you can, if you add all of these things, then basically you're gonna, make the trade-off between aggregate demand and balance sheet effects less sharp, because there is a benefit from depreciating your currency, and that's the one you just mentioned. Yes. So here it's not in the model.
Right. The countries you mentioned are kind of different, like Brazil and then Peru. Like Peru exports a larger share of their output compared to Brazil, and I don't know their balance sheets, but I also could imagine that among the countries you have at the beginning, their corporate dollar debt is also gonna be very.
Yeah. So they definitely. So in reality, these countries are definitely not symmetric.
Yeah.
Okay. Here, you can extend them all to get something that's completely asymmetric, and you will get the same kind of results with like indexes everywhere, right? But you're right. If a country, for instance, has less dollar debt than another, it's going to face less of that problem, and so there's going to be less of it. If the country benefits from the depreciation of the currency, the trade-off is not going to be this one, and so you're also not going to be a point. So I'm really focusing on the countries where a depreciation of the currency, a large depreciation triggered by US monetary policy shocks, is costly, right? And that's the way to get it. And then there are other forces that make it less sharp, but yes. Then you need a full model to look at them.
So like in the mechanism, why does the intermediary requires a higher premium when it intermediates more flows in dollars because it's more exposed to balance sheets through the firms it lends to?
So there are different ways to get that result. So I don't know if I have time to show you when we get there, but in the paper I have 4 or 5 different microfoundations for how you get this, and they all lead to exactly the same functional form in the end, which is the size of flow determine the premium.
Right.
There. So the reason is different type of reasons. In capex and inventory, it's a financial friction. It is that if I don't compensate the intermediary enough for a large balance sheet, they have an incentive to run away from the money, with the money, sorry. And so to make sure that they don't run away with the money, I offer them a higher compensation for doing the job. And so that's why you get that size, that link between the size of the balance sheet and the premium. What else? In Bianchi and Lorenzoni, it's a pure cost effect. It's like, if I need to intermediate more, that's a convex cost of doing it. And so that translates to the same thing. Yeah, and so in Fontanier and Straub, it's something even different because it's also linked to cost. Each intermediary cannot expand the balance sheet to infinity. They have a fixed size they can use, and they have like heterogeneous entry costs. So the more I need to intermediate, the more less productive intermediates need to enter the market, and that translates into a higher price of intermediation. What else do I have as a microfoundation? I don't remember. But there are 5 or 6 different, and they all lead to the same thing. But the ultimate reason, at least for that model, is not that important for what that's the case. I just need this very reduced form that tells you size of flows translate into a higher premium. But there could be different reasons for why that's the case. The main one of financial frictions or just cost of intermediation. That comes from regulation usually, right? But yes. Okay. So if you do have these bottleneck externalities that go through these balance sheets, you get spillovers, and so an immediate conclusion from these spillovers is that there is gains from monetary policy coordination. So these central banks should, in the model, realize if they go together that their coordinated action has a cost going through the balance sheet of the intermediaries, And so the coordinated equilibrium looks like something where they still respond to movements in the exchange rate due to dollar shocks, but in a dampened way, okay? And so you still get a global financial cycle. It's still costly because we still cannot completely get away from that trade-off. Our currencies are going to be somewhat depreciated from that change in the external interest rate. But taking into account this excessively aggressive response because of the balance sheet of this intermediary, we're going to get something that's dampened, and so we're going to get less output gap and higher employment in all of these countries if they internalize the cost of going through the intermediary. Okay, and of course,
does that depend on the level of rigidity? Like the W bar is the heterogeneous of those countries, like
yeah.
So the coordination is optimal given that the probability of having a binding nominal wage rigidity is the same for across countries, or does it depend? Or it doesn't depend on that.
No, it should depend on that, right? So if for some reason you manage to not have this rigid wages constraint that's binding, then you won't face a trade-off basically, right? Because I can just do whatever I want with my interest rate to fix my currency. That's not a cost for aggregate demand. But actually, if I do this, I'm still imposing some externalities in other countries, right? Because I'm still trying to play with capital flows to fix my balance sheet effects. Okay, and so I'm still going to impose externalities on the others. What's true though is that if I don't face this aggregate demand effect, then I have no incentive to coordinate with the other countries, right? Because what they're doing is of no interest to me. I don't incur any cost in that moment of moving my interest rate because my wages are pretty flexible in that equilibrium. And so then I'm going to be very costly for the others because I'm going to try to attract capital flows to do whatever I want, but not internalizing any cost of doing so because I don't have a flexible rigid wage constraint. That's going to be a problem actually. That's the case, yeah. But that's an interesting extension that I should try to.
Well, can you elaborate on this coordinated equilibrium? So the monetary policy rates in the emerging countries are lower.
Yeah.
And that leads to higher employment and output. But how does that dampen the global financial cycle?
So it dampens the global financial cycle because by doing so, in that equilibrium, we're going to attract less capital flows. So the balance sheet of this intermediary is going to be less constrained. And so the interest rate the intermediary is going to require for intermediation capital is going to be lower, which is a force that helps appreciating relatively the currencies. And that lessens the effects on the balance sheet. So that's why we get less cost.
Okay, so it's less depreciated than in the
uncoordinated equilibrium. Yes. So you still have a global financial cycle in the sense that this interest rate is still going to be moving around, but less than in the uncoordinated.
Okay, but what I have in mind with the global financial cycle is capital flows from emerging countries to the US. It's like a safe haven. Now, if interest rates in emerging countries are lower in the coordinated equilibrium, I would have thought that capital would flow even more to the US.
Yes.
So that would be like exacerbating the global financial.
Yes. So it depends. You're right. Some of the things are going to be exacerbated. Some of the things are going to depend. What's going to be dampened are the welfare costs of the global financial cycle for this emerging market. But you're very right that some of these things could be more volatile in the coordinated equilibrium because basically you let them live. That's very true. Yes, that's a good point. Thank you. But I still want to point out this is the coordination equilibrium is tricky because each country has still an incentive to deviate from that coordination game, right? Even if you agree with all of the central banks to impose a lower interest rate to get away from these volatile externalities, then you still face that trade-off. And from the perspective of your own country, you still want to deviate and actually impose a higher interest rate to try to get a higher appreciation than the coordinated equilibrium. But this is very hard to put in practice, and so that's why in the last part of the paper, I'm going to study macrofinancial policy from the point of view of one country and show that it's optimal to, in that mode, discourage dollar debt issuance and limit the currency inflation of the firm. But the interesting result, because that's a general feature of this thing, right? The more interesting result is that these macrofinancial policies are actually having positive spillovers between emerging markets. Okay, so you have negative spillovers of monetary policies when you're trying to respond to these shocks, but the ex-ante imposition of macroprudential policy actually has positive spillovers between emerging markets. And the idea here, I'm going to go back to that at the end, but the idea is if I impose macro-pro, I limit the currency mismatch on the balance sheet of my firms. When the time comes and the Fed actually tightens the interest rate, I don't face that much of a trade-off because my firms do not have this huge balance sheet effect coming from the mismatch of the currency mismatch. So I don't need really to try to appreciate my currency to respond to this dollar shock. And so if I don't need to appreciate my currency in response to this dollar shock, I'm not trying to attract capital flows at the expense of the others. So basically, if a country like Peru forbids currency mismatch, they don't have to play with their currency when the time comes the Fed tightens, which makes it easier for the countries to then appreciate their own currency in response to the Fed shock, because I'm not imposing any bottleneck on the balance sheet of this intermediary. Okay? So that helps the other. By helping my own central bank doing a better job in the future, I'm actually also helping other central banks having an easier trade-off between aggregate demand and balance sheet effects in the future. Okay, so that's the main result of that part. The one thing that I want to talk about at the end is what happens if you have access to foreign exchange interventions. So not just the interest rate to play with that trade-off. And here I'm going to show you that it's great to have access to foreign exchange interventions in that setup because it releases the pressure on the interest rate, so it can target more the aggregate demand side of the economy. That's better. The one thing that happens in this model, though, is that if I do this, my firms internalize that I'm going to use foreign exchange interventions to appreciate my currency. And that actually increases the incentives to my firms to issue debt in dollars, which is again going back to the same comment before. And so if I want to have access to foreign exchange intervention, I actually need to impose tighter macroprudential policy ex ante if I really want to increase welfare on the expectation base. Okay, let me skip the literature so I can show you the model and the rest. Okay. So what is just the layout before going to the equations? Is there a clock so I know how much time I have? It's not here. Sorry?
It's 12 o'clock.
Okay, so I have 1 hour.
Yeah.
Yes,
Perfect.
I'll let you know.
Perfect. Thank you. Plenty of time. So what is the layout? So first we start just with one small open economy, and then we go to the case where you have many of them. But let's start with just this. Two types of agents. So the households are just going to supply labor. They're going to be very passive in the model because the actions is not happening there. But there is a wage rigidity constraint, which means that if the interest rate is too high above the natural rate of interest, that constraint is binding, and so I get aggregate demand effects. Again, demand for non-tradable goods is too low, and so the production of non-tradable goods is going to be too low. And then there are entrepreneurs that borrow in dollars and in pesos. They produce non-tradable goods too. But so if you produce non-tradable goods and you borrow in dollars, then you have a currency mismatch, and they face a financial friction that gives rise to that. Okay. So the timeline is the following: in the first year, these entrepreneurs decide how much they want to borrow in dollars and in pesos. That B1 star here in orange is going to be the most important variable in the presentation. So I'm going to keep it in orange during the whole talk. That B1 star is decided at time 1. Then at time 2, that's when they can have a dollar shock that changes the exchange rate, and that's when the central bank faces the trade-off between financial frictions and rigid wages. What is the financial friction? That these entrepreneurs at time 2, they have this amount of debt in dollars from before. If they want to maintain the capital stock in order to keep producing at time 3, they need to borrow some money at time 2, but they face a financial friction allowed from zero, which makes the net worth an important variable for the level of investment that's possible at time 2. And because net worth depends on the exchange rate, that's where the trade-off is coming from. So the way I'm going to do this is that first, I'm going to take B1 star as given. So let's just assume that we know the decisions of the firm, the entrepreneurs ex ante. We have that B1 star. At time 2, what is the optimal monetary policy response of the central bank? Trading off these two things. And then once we have this and we understand this, then we can go back to period 1. What is the optimal amount of issuance in foreign currency from entrepreneurs, taking into account the optimal monetary policy response at time 2? And once we have this, we can ask the question of what is the optimal macroprudential policy that tries to influence that level of dollar debt B1 star in order to ease the work of the central bank. Yes.
What pins down the share of debt per currency? What is
the first here?
Yes.
Yeah. So here, so there are many reasons for why firms issue in dollars, right? I don't really want to take a stance on it in the paper. So the way I'm going to do this is that originally it's cheaper to issue in dollars, which is why firms do it. And then they face upward supply curve. So if you issue a lot in dollars, the interest rate is higher on the debt. And so they issue in both currencies in order to be indifferent on the margin between the two.
That's the first start issuing dollars as much as they can, and once The cost in pesos is the same.
Exactly. The issue was in peso. And so why do I do this? Because you actually want, that's an interesting point, you actually want firms to have debt issued in dollars and in pesos. Because if you want to do macroprudential policy, you want to put a tax on issuing in dollar, they need an alternating source of financing, right? Otherwise, that macroprudential policy is just useless. They're still going to keep issuing as much as before. So that's why by having these two things where you're indifferent on the margin, they're going to switch from one source of financing to the other, and that's how you're going to get a meaningful trade-off. Yes, in the most, it's going to be very useful. You face this upward supply curve, and then you decide how much to issue optimally to minimize the cost of issuance. Yes, please.
So, I thought at some point you would have some choice by the firm to issue in pesos or in dollars. I'm thinking about the Salomao paper.
Yeah.
Yeah, Salomao Varela paper.
Yeah.
So basically, they say that if you issue in dollars, it's not really about because dollar debt is cheaper, but because it correlates. You as a firm self-select that the shocks, the productivity shocks correlate such that they make sense with the exchange rate exposure. So I thought that goes to the heart of the balance sheet.
So sorry, just okay. To your first question, there is a choice between dollar debt and peso debt in that mode. It happens at time one. So they decide how much to issue in dollars and how much to issue in peso. So I didn't write it here, but there is a dollar debt level B1 star and the peso debt level B1. It's just that B1 is not important for the rest.
And what determines that choice?
So here it's you face two different supply curves for issuing in dollar and for issuing in peso that have different elasticities. But the issuing in dollar one is cheaper at first. So if you issue just a little bit of debt, you would like to issue just in dollars because that's the cheaper one. But then at some point, by issuing more debt in dollars, it becomes more expensive, and then it becomes valuable to also issue in peso, but to the point where these two interest rates are equal. That's what happens.
Maybe not right, but so every firm has the same incentive to issue as
much
debt as they want, as they can.
Yes.
And then they start issuing in pesos, but that's not really the Varela story.
No, that's not the story at all. But so that's why I was saying I don't want to take a stance for why they issue in dollar. So in the most, it's going to be because it's cheaper. There are other reasons for why they want to issue. But there's a signaling effect. There's just the fact that banks offer loans in dollars in a country like Peru. That's also in one of the Salomao paper. But these things are like all bundled into the reduced form stuff of it's cheaper to issue dollars first, and so that's why I have some dollar debt.
But for your prudential optimal policy, you need a reason why they issue in dollars.
Yeah, but the reason is for Korea is that it's cheaper. Yeah. Yes. But there are
so you need to dig deeper on that.
Well,
you see what I mean?
Let me provide a second example. Yeah. So I saw you mentioned one practice paper. So in Chile, if you see which firms actually borrow in dollars, you will see that they somehow they follow the patterns that Salomao Varela mentioned. They're the largest firms, of course, and you could say that's because of access. They're also the more productive. But the one thing that I think is new in that paper is that firms usually borrow in dollars because the supermarket in Chile borrows in dollars because they want to have a supermarket in Argentina, right? So basically their currency exposure for the balance sheet is very limited because they have also assets. So because they see the investment opportunity borrowing dollars and it correlates and that.
So here, let me be very clear. If your firms can issue in dollars, but are then not be having a currency mismatch in period 2, then you don't face this problem, this trade-off with central bank, and these things go away. Okay, so you need a currency mismatch. That's very true. And here, the way it's done is just that central banks are going to have production only in non-tradables. Okay, and a part of their borrowing is going to be in dollars, so that creates directly a currency mismatch. So you need a currency mismatch, otherwise there is no trade-off for the central bank. That's very true. Yes. So that's why this does not apply to every country, and it doesn't affect all situations, but that's definitely the picture of them all. Now, let me say one more thing, which is it's going to be here when I go to the externality, but the externality I'm proposing, the bottleneck one that I showed in the previous slides, does not really depend on the idea that this is because of dollar debt. This is going to be a general force in the general externality this more, in the sense that if for some reasons these countries care about the level of the exchange rates and they need to respond in a synchronized way to dollar shocks, then you get the same kind of externality. The good thing about dollar debt is that it tells you why they have a fear of floating, and it also tells you why you can do something about it with macroprudential policy. These are two different things, but it's going to be clear when I go to the slide. Now, and still just to go back to your point, you do understand why they issue in dollars. That's very true. In the end, when you look at the optimal macroprudential policy from the perspective of one country, basically you want to understand two things. You want to understand if I do macropru, how much that's going to help my central bank target agreement in an easier way. That's the benefits. And then you want to understand the cost of macroprudential policy. Right? Here, the cost is going to be simply if you cannot issue that much in dollars, you have to issue in the other currency. That's more expensive, and so that's a cost for investment. That's going to be the trade-off. Yep. Then if you replace the reason for why they issue in dollars from it's cheaper to something else, the reason for why there is a cost of macropru is going to be different. But the lesson is always the same. You want to equalize marginal cost and marginal benefits, and so you need to understand what the marginal cost is. Yes, but I agree with you. And here it's because of cost, because that's an easy way of doing it. If you think of something else, you need to understand cost of macropru in the same way and equalize the benefits with the cost and the margin. Does that perfect? Okay. Now, one of the sorry, I'm just finishing on this because that was a very good point. One of the reasons why I don't want to take a sense on why firms issue in dollars is that because in different countries there's a different reason for why they do so. And I want to keep them all as simple as possible. So that's
Just honest related to that. I mean, like they say in Chile, if I had debt in dollars because I sell in the export market in dollars.
Yeah.
And the macroprudential policies to like restrict the possibility to have debt in dollars. Maybe you're going to create more mismatch.
Yes, so that's very true. Yeah. So here you don't see that. I say macropru, you want to restrict debt in dollars, and that's because your firms are naturally mismatched. But actually, you're right. I should be more careful. What you want to do is reduce the currency mismatch.
Yeah.
And it's not, so you don't want to tax issuance in dollars for firms that have revenues in dollars. That would be a mistake. That's true. In the model, it's the same thing because everyone is a currency mismatch. But you're very right. Yes. The target of macropru here is the level of the mismatch, not the level of debt. Yes. Thank you. That's very good. Okay, let's keep going. So, what is the exact structure of the model? So again, it's going to be very stylized, right? So you can see where the trade-off is coming from. So two goods, tradables and non-tradables, that's standard. The households are going to be very passive. Okay, so they consume these two goods. They're going to have linear utility in the last period because that's going to make everything very tractable. That's just a nice trick that doesn't kill any of the intuition. There's one thing to remember for the first part of the paper. Is this raw parameter that's here. Okay, so it's linked to the elasticity of interpole substitution between period 2 and period 3 for these households. Okay, I'm going to come back for why that's important, but please just keep in mind that this is the one parameter that you need to keep track of in the model. The household supply labor, they can save in bonds in local currency with a zero net supply, and they can also save in bonds that are denominated in dollars. Okay, so A3 star is going to be the number of bonds that they have, whether they borrow their sales, that's positive or negative number, and I2 star is going to be the interest rate at which they can borrow or save in dollars. Okay. So for now, that number here is completely exogenous because there's just a small open economy. So let's say it's just signed by the Fed, and then when we go to the next section where you have many different countries, this rate here is going to be pinned down by the balance sheet of the intermediary. That's going to be the important. For now, this is just a number that I have to live with, and let's just say that it comes from the Fed. So two ways of producing non-tradable goods. The first one is the usual perfectly competitive continuum of firms. They have linear technology to produce non-tradable goods, but they can offer only fully rigid wages that are a normal to one, and that's going to be the first key friction here. If you set the interest rate too high, then that is binding, and so you get involuntary unemployment, and so an output. So basically, your households are going to supply an amount of labor that's strictly less than this end bar if the interest rate is too high. And then, because I don't want this effect that you mentioned, the tradable goods are going to be in endowment at period 2 and 3, and the lower bound price is going to hold. So the price of tradable is equal to the exchange rate. The usual convention, if that number goes up, your currency depreciates. It's more expensive for you to buy a unit.
Well, don't you have capital there?
Not yet.
No, you're going to have.
Not yet. So that's to separate completely the two things and have a trade-off between basically aggregate demand and balance sheet effects. These firms, they produce without capital using the households. That's where the rigid wages are coming from. And then you have entrepreneurs that also produce non-tradable goods without labor and then capital. That's the trick to
Those are solopreneurs, basically.
exactly. That's the trick to make this completely separable. You could do something more complicated and you have the same trade-off, it's a bit more complicated, that's all. So again, these entrepreneurs, so remember they were there in the previous period that we're not considering for now, and they decided to issue, for whatever reason, some amount of debt in local currency, that's B1, some amount of debt in dollar, that's B1 star. They use this to build a capital stock K1 that produce some units of non-tradable goods, that's eta 2. And so when they enter period 2, they have a net worth level that's basically production. So eta 2, the productivity of the capital stock, times the capital stock, the debt they need to reimburse in local currency, and the debt they need to reimburse in dollars, and that's where the exchange rate comes in. So you see directly here, if the exchange rate depreciates, E2 is higher. So the amount of debt you need to pay back in dollar is something that's bigger in local currency, and so the net worth is also lower. Okay. Now, if you don't add any financial friction, the net worth of this entrepreneur is completely irrelevant, right? So you need to add financial friction a la Tiro to have a link between net worth and how much you can invest. The way I'm going to do this, another trick that comes from this paper covering Krishnamurti, that's very easy to work with, is that so these entrepreneurs at time 2, once they produce this, they're faced by random shocks. Some of them are still productive, and some of them are not productive anymore. The productive ones, that's a production kappa. If they want to keep producing, they need to maintain the capital stock. For this, they need to pay some amount of money, that's S of non-tradable units per unit of capital stock that they want to maintain. And where they can get the money is from these unproductive entrepreneurs. So the productive ones want to pay that amount of money in non-tradable goods. They borrow from the other unproductive entrepreneurs, but there is a financial friction. Whatever friction you want, but just the one from TO 2010, the usual one, is that the amount of debt you can borrow from these unproductive entrepreneurs is limited by the pledgeability of the new project, and that R0 is a number that's lower than S. And so what happens if you do this is that simply if you constrain entrepreneurs, the amount of capital stock you can maintain is a direct function of two things. First, the level of your net worth, and second, the size of the financial friction. Okay, it's quite standard, but you get these things are very, very easy to work with. So why is it that this creates a trade-off? Because now there is a role for monetary policy. Monetary policy will change K2, that's the amount of capital that can maintain at time 2, that will be able to produce non-tradable goods at time 3, by changing not S or R0, but by changing N2, which is the net worth of these agents. And so how does that work? If you change the interest rate, you change the exchange rate, and that changes the net worth of your agents because they have a currency mismatch. If you don't have a currency mismatch, this is going to be relevant and the effects will go away direction. Okay, so what's the trade-off? You want to maximize the welfare of the plentiful consumer, and you only have one thing, which is the interest rate. So the first thing you want to do is target aggregate demand or output gap. So what happens if you increase your interest rate? Usually it's credit switching it.
No, it's fine. No,
Okay. Exponential switching effect. So if I increase the interest rate, I'm reallocating demand from non-tradable goods to tradable goods, but because the wages are fully rigid on the non-tradable side, that's going to lower the outputs of non-tradable goods, so that's going to create an output gap and unemployment at the same time. So if you increase the interest rate, you decrease the output of non-tradables at time 2. That's the usual thing. But the trade-off is the following, which is going from the balance sheet effects. Your exchange rate is pinned down directly by the level of the interest rate through this UIP condition. And so if I increase the interest rate, I appreciate my currency, that's a lower E2. So because my net worth was like this, if E2 goes down, N2 goes up, N2 goes up here, multiplied by the net worth multiplier, K2 increases, and so the output of non-tradable at time 3 is going to increase because CPI is okay. That's why I have these two different things, right? So they affect the two things in opposite direction, and it's just completely separated by agents and in time because it's at 2 and this is at 3. Okay, so that's the trade-off. You want to lower the interest rate to close the output gap. You want to increase the interest rate to appreciate the currency. And so what is the optimal monetary policy when that's the case? Where there's going to be a threshold, and then you can call it B tilde if you want. And the idea is that if the amount of debt issued in dollars at time 1, again, remember that it is as given for now, is higher than this threshold, then the trade-off is biting in some way, which is I cannot fully target the output gap and the aggregate demand effects. And I have to allow for some underemployment. So my interest rate is going to be higher the natural rate of interest, you're going to get this very natural prediction, which is the level of the domestic policy rate is going to be increasing in the level of dollar debt. That's simply because there are more dollar debt, there are more currency mismatch, and so the balance sheet effects are going to be stronger. So I have to put more weight on the second effect, involuntary unemployment. So the amount of labor supply is going to be lower than this number here. And the level of the domestic policy rate is also going to be steeply increasing in that item star, that external rate of interest. Why is this? You can see that directly from this UIP condition. When I2 star goes up, my interest rate depreciates, and so the balance sheet kicks in, and so I need to increase my interest rate to increase in output at times 3 of non-tradable by saving the net worth of my interest rate. So you can see that very clearly if you assume rho equals 1. So remember that elasticity of the growth substitution. That's because when you do rho equals 1, everything becomes fully separable. It's basically of utility. And you can see that the optimal rate of interest has this very easy formula where it depends on the level of debt in dollars, the size of the financial friction, and that external interest rate I2 star. And if all of these predictions that I mentioned here are in that equation. Okay? So I2 is going to be increasing in I2 star. So if you think of this as being a link to the rate set by the Fed, you get this global financial cycle synchronization of policy rate that I was mentioning before, in the sense that if the Fed raises the interest rate, I2 star increases, I have to increase my own domestic policy rate to appreciate my currency. And if I'm not the only country facing that V1 star problem, then we're all going to do the same thing and responding in exactly the same way to this shock to I2 star, and that's going to give synchronization that was mentioned before. Okay, is that okay for everyone? Now, once we understand this, we can actually now go to the consumer countries. And so that's why we need to do the CAPEX and Madrid. But now, before doing this, let me just mention a few things such that it's relatively clear why these spillovers are new here. So I'm going to assume that you have this continuum of emerging markets that are still small relative to the rest of the world. Okay, so this is not a spillover of if every country in the world does the same thing, then the price increases for market clearing reasons, and so that creates. This is not what's happening here. Okay, so the set of countries that are facing this dollar debt problem in this mode is not big enough to influence the world interest rates. Okay, so in typical modes, it would stop here. There's no spillover if you don't influence the world interest rate. And here it's not going to be the case because of this intermediary. So that's new. And because these countries are small, the price of tradable goods is also going to be still fixed. So it's not big enough to influence the market clearing condition of the tradable goods in Ethereum. And so the price of tradables is not moving with our policy action. So again, the spillovers are not coming from the fact that the price of tradable goods is going to move with synchronized action. Okay, so this is really a new class of spillovers that works not through GFX at the world level, but through the balance sheet of these intermediaries. Okay, so I'm going to add this layer of intermediation, of frictional global financial markets that come from the seminal paper by Gavex and Majori. But again, you can microphone this stuff using any type of other subsequent work that basically goes to the same result, which is that in the end, there's going to be a premium on the dollar rate. So the dollar rate that we face as emerging markets is going to be this I2 star here, is going to be equal to first the dollar rate, so that's the one set by the Fed, and the Fed does whatever they need for their own inflation reasons. So that's going to be exogenous, that's the Fed shock. And the wage between these two things, so the wage between at how much we can save and borrow in dollars and the rate set by the Fed, is going to be pinned down by the aggregate size of net capital flows that come from these emerging markets. Okay, so that's why we're saying to get this functional form, you can use any of these micro foundations that are here. You get exactly the same thing, whether it's financial frictions or cost of intermediation. It gives you exactly the same functional form. Okay, so there is an equilibrium relationship between the wage, the dollar premium, and the size of aggregate capital flows coming from this set of emerging markets.
So in the previous, the wage is a function of the sum of each country's trade balance.
Yeah.
Right. But in those countries that you showed, you have plenty of countries with trade surplus, no? So
yeah. So that's the beautiful thing. It actually doesn't matter.
Doesn't matter.
No, that's great. So you would think that these things would happen only when these things is largely positive, so we borrow a lot, and so that's why this is bigger than this. But actually, that doesn't matter for spillovers. What matters for spillovers is the marginal effect on the interest rate that we face. So basically what matters is what is the derivative of this I2 star with respect to our own policy actions. And here, whether you are a saver or a borrower in equilibrium, does not change the fact that if you increase your interest rate marginally, you attract more capital flows. So you increase this thing, and so the marginal effect is positive on that rate. I'm going to show you more precisely what happens in
So you if it's ante, all trade balances are in equilibrium, it doesn't matter because eventually you adjust to equilibrate the marginal benefit and marginal cost in the
So it's there is this, but there is something else. Let me come back to that in a few minutes. But remember that your own net position does not matter for spillover, and even the aggregate net position does not matter for spillover. That's in a sense, the size of this wedge is not what happens for externalities. What you want to understand is whether this wedge is increasing or decreasing with your own policy action, and it's always going to be increasing. Whether the wedge is positive or negative has no bearing on the size.
So this question is out of my ignorance, but it sounds like magic to me that for any of these reasons, the gamma is going to be invariant to counterfactors.
No, you're right. That's not the case. No, that's not what. Sorry, it's not what I said. I misspoke. I'm not saying that the level of gamma is the same in all of these models.
No, I know, but gamma here is a parameter. You're going to treat it as a parameter.
Yeah. So then the next step is where is this gamma coming from? And then you're saying it's going to depend on policy rate. That's true, and that's not in this model. Right. It's a bit in a ad-hoc way in Gabex Madrid because they, for some reason, assume that gamma is equal to the variance of the exchange rate. You don't know where it's coming from, really. That's my next paper. So let's talk about that.
Okay.
Okay. But here, no,
Here we treat it as a parameter.
Yes.
Okay.
Exactly. So exactly like, if it comes from financial friction, it comes from the fact that these things like here, this parameter here is a total, right? The same thing. If it comes from a cost function, it comes from the fact that just is costly to intermediate, and that's the cost parameter. Yes. So here gamma is completely invariant. Yes, that's very true. The reason why it's invariant is that it's not clear in which direction it would go, depending on the micro foundations for why that parameter exists, but we can talk more about this.
Okay.
It's an interesting question. Yeah. Okay, so let's start with the case where actually, even though you have all these things I mentioned, you don't have spillover. Is that possible? So yes, let's do the rho equal 1 case, which is very instructive because everything is fully linear, closed form, whatever you want. But it's instructive of the reason for why you get spillovers to look at this case. Okay, so remember when rho equals 1, you have this very nice formulation for what is the optimal rate of interest. Okay, and whether rho was equal to 1 or no, you still have the same force, which is I2 increases with B1 star, with R1, with I2 star, and so on and so on. Okay. Now, the one thing what happens in this model where rho equals 1, where basically you have log utility, if you work with these models, you know that there's I don't know if it's dirty or not, but a little secret behind them, which is when you do log utility or several cases, you get this relation here, by looking at the Euler equation on the tradable consumption, that the amount of goods in equilibrium that you consume of the tradable one is completely independent of the domestic policy rate. That's what happens in this model. If you do separable utility between tradables and non-tradables, the two things are perfectly segmented. How much I consume of the tradable does not depend on I2, and how much I consume of the non-tradable does not depend on I2 star. Okay, that's what happens in this model. So why is this important? It sounds like a weird technicality, but actually it has a big implication because that means that the trade balance is going to be completely independent of the level of the domestic policy rate. Whatever the central bank is doing, it still changes the exchange rate through the UIP condition, but it's actually not changing capital flows in equilibrium, right? Because the amount you consume of tradables is fixed, doesn't depend on I2, and the amount you produce is just given by the endowment, so the difference between the two is basically independent of I2. So you can look at your...
But that's because the endowment production is
yes.
endowment.
Yeah.
It's endogenous is another story.
Yeah. Then of course,
strong assumption.
It's when it's small strong assumption, it's yes, because I want to get rid of this effect. Yes, you're right. But all of these models that work with tradable endowments have this exact same thing in there, that if you assume linearity because you want tractability, then you get capital flows that are completely independent of I2, which is counterfactual in a sense. But so why does that matter in this model? Not just that it's counterfactual, it matters in this model because the size of the capital flow is independent of the domestic policy rate. And so the size of this wedge, right, between the dollar rate we face as emerging markets and the Fed one, there is a wedge that depends on the size of capital flows and the size of financial friction. But whatever we do with our own policy rate, whether we are very aggressive in responding to the Fed or whether we basically don't respond to the Fed, does not change that wedge at all. So it could be positive, it could be negative, but the marginal effect of our own policy actions on that wedge is always zero. Okay, so that's why you don't get any spillover. So if that's the case, then you still get a global financial cycle, but it's constraint efficient in the sense that there is no reason for each of the central banks to try to understand the effect they have on other countries. And so that's what I mean by constraint efficiency. So why do I think this is interesting? Because it tells you directly that if you break this link, if you make a link more precisely between the consumption of tradable and the domestic interest rate, something here is going to occur that's going to break that inefficiency, and you can see it just by looking at the general equations of the. So just looking at the equilibrium conditions and trickle up or down depending on the perspective, you see where you get a spillover from. So the Fed tightens the interest rate, their own interest rate that depreciates the local currency. Balance sheet effects kick in because of the currency mismatch on my firms. The optimal response is to increase my own policy rates. If rho is bigger than 1, that means that I attract capital flows. Okay, that's the usual effect that we have in mind. I increase my interest rate, I attract relatively more capital flows. And then it means this number here, capital flows for each one of these countries is increasing, which means that the marginal effect on this balance sheet equation is positive. So if everyone increases at the same time, the size of flows increases, multiplied by this position number gamma, the size of the wedge. So that's what I was saying. It doesn't matter whether that wedge is positive or negative in equilibrium. You can still here have all of these countries being net savers, which means that they're going to have an interest rate that's lower than the Fed one. But if relative to that equilibrium when everyone is a net saver, everyone increases relatively more their interest rate, this thing is going to be less negative, so it's increasing. The wage is reducing, but that still increases I2 star, which fits back into the domestic economy because higher I2 star leads to a further depreciation of the currency. That's why this thing doesn't matter. What you see here also, and I want to come back to that at the end, is that in this mode, your own position is completely irrelevant. It's the aggregate one that matters, right? So you could write the same model where some countries are net savers, some countries are net borrowers. Spillovers are exactly the same. Okay? So that's an important one. Okay, because what matters is whether we face a higher interest rate. It doesn't matter whether that interest rate is higher or lower than the Fed one. It's actually relevant for the spillover. Okay, so we all increase our interest rate, increase capital flow, tightens the balance sheet of the intermediary. The intermediary requires a higher compensation for doing the intermediation. I2 star increases, goes back to the UAP condition. E2 goes up, and then I go back here, deflationary pressures, balance sheet effects, and I keep doing this up until I reach the fixed point in the model. Okay. So what is the bottleneck externality here? It's just the fact that my domestic decisions spill over to this I2 stars for the balance sheet of my intermediary, and that's the expression I have here. But you really need two things for this to happen. You need rho bigger than 1. That's the number that's here, because otherwise you don't get the link between interest rate and capital flows. And then you need gamma to be bigger than 0, because if gamma is 0, these intermediaries are not constrained. They don't face cost of intermediation or financial frictions. And so they always pass through the Fed rate 1-for-1. And so whether we ask the intermediary to intermediate a very large quantity of flows or a very small one, doesn't change the fact that we all face the same I2 star. That's equal to I2 dollar. And there are no spillovers between the countries. So it's the product of these two things that create these spillovers between emerging markets at the same time. Okay, so now going back to the question of whether the currency mismatch is crucial for the spillover or no. Here, these spillovers exist in any case. Oh, sorry, let me show you the next slide. It's going to be clear. Okay, let me come back to that in 5 minutes. Sorry. If you have spillovers, then you of course get the need for coordination. What is the coordinated equilibrium, where you take the spillovers into account? So you implement a lower interest rate, and so you end up with higher employment and higher outputs at time 2 because the interest rate is lower. You get closer to closing the output gap, but also because you internalize the fact that too much capital flows depreciate the currency of everyone. You get a balance sheet of the intermediary that's less tight, and so you get less depreciation in all emerging markets, and so you get a lower interest rate on these dollar savings. That's the coordinated equilibrium. Now, let me discuss the result very quickly, and that's the condition number 3 I want to mention. So first, you need the fact that money tightening brings capital flows. Okay, so in general, in the general model with like general utility function, it's not just rho bigger than 1. You need the elasticity of intertemporal substitution to be lower than the substitution between tradable and non-tradable goods. Okay. In that model with Cobb-Douglas and linear utility at period 3, it boils down to rho bigger than 1, but that's the condition you want. Okay. If you don't like that thing and you want another way of getting the fact that monetary tightening is bringing relatively more capital flows, you can do it other ways, and it's in the appendix of the paper and of these slides too. You can add financial frictions on the intermediation of dollar savings domestically, and you get exactly the same. The second condition that's very important is that it's the size of aggregate flows that actually matters for the intermediary. Okay, so the way I wrote the equation, it looked natural, but actually there is an assumption behind this, and the assumption that this global intermediary is viewing the flows between all of these different emerging markets as substitutes. Okay? In the model, it's actually more extreme than that. It's like perfect substitute. They don't really care if the country is Brazil or Peru or Mexico. It's the same thing. A capital flow is a capital flow. Okay, you can write a more complicated version of that, but there is some necessity of substitution between these countries, and then the spillovers might be dampened or exacerbated, but the idea stays the same. Why do I mention it? Because it really highlights something that's maybe a bit new in the literature, that in generating the spillovers, you need to, it's not just the G effects on price of tradables on the world interest rate, it's also the importance of the investor base. So if the investor base, the ones that are doing this simulation, is very constrained, you're going to get high spillovers. If they're not, you're not going to get high spillovers. Now, from an empirical point of view, what you would like to understand to get a sense of whether the spillovers are large or small is to get some kind of cross elasticity between. So, is it the case that when I increase my capital flows, let's say from Brazil, the intermediary is also requiring a higher premium to lend money to Peru? Okay, that's the cross elasticity I'm mentioning here. And you want to understand whether that leads then to a depreciation of their currency, right? There is some work that's trying to get at these cross elasticities, actually especially in the case of this paper here, and by actually looking at the balance sheet of the intermediaries, and they do find significant results, even though they're actually looking at developed currencies like G10 currencies. Okay, so my intuition is that these effects are probably going to be even bigger for emerging markets, because typically that's why the balance sheet of these intermediaries are even more constrained. But that's just an intuition. Okay. So you could think of something. Let me show you. You could think of a different model where markets are really, really fully segmented. So something like this, where you have a set of different emerging markets, and actually all have a different intermediary. And each of these intermediaries is completely independent from each other. Sorry, that should be a different number here. And they all have access to the Fed. If you do this, the positive predictions of the model are going to be very similar, right? So these things are constrained, then that's going to create depreciation effects and so on and so on. But you will not get any spillover effects between countries if you do this, right? Why is that? Because whether here Peru tries to attract a incredibly high amount of capital flows, their arbitrage is going to be very, very constrained. That's going to require very high I star here to the intermediation. It will have absolutely no bearing on the I2 star required for other emerging markets, and so you will not get any of this. So it's really crucial that this arbitrageur, in a sense, either is the same one for everyone, or there's some kind of scarce capital going on between them, and so the effect on one balance sheet has an effect on the other balance sheet. Okay, but so that's why I was saying the assumptions behind how you write this functional form for the intermediation is non-locus. They all lead to the same thing in the sense of quantity goes to wage, but they do not lead all to the same thing in terms of whether what matters is the aggregate size of flows coming from that set of countries, or just one by one size of flows coming from each country. Okay. The fact you have cross elasticity here suggests that the one I used in the model, generic spillovers, is more relevant. But again, more work is needed to understand whether that's also the case for emerging markets. There's a little bit of that in the new paper by Helen, but not exactly. Okay, now going back to the point about the currency mismatch. So to get this spillover effect, you need some kind of synchronization of monetary policies, in the sense that all of these countries are trying to do the same thing at the same time, which is to attract relatively more capital flow. So here, this is because of this currency mismatch stuff. I do want to highlight that this is not the only way to look at this result. So this is a set of papers, for instance, that are very famous, that also get that kind of synchronization of monetary policy. The same thing would happen if in these papers you had the same kind of intermediation I had. So if every country is trying to attract capital flows at the same time, for whatever reason, maybe that's not currency mismatch, but for another reason, they're all trying to attract capital flows at the same time. And they face that intermediation friction that tells you that the wage is given by the size of flows, you get exactly the same spillover, which is attract capital flows that is at the expense of another country, and that's going to be painful for them. You get the same thing. I do dollar debt. Okay, so that's an assumption in the model. I like that assumption because first it gives you synchronization of monetary policy vis-a-vis US monetary policy shocks and not any kind of shocks, which seems to be there in the data. But also it allows you to study ex ante policies because there is a margin of adjustment you can play on as a policymaker because that decision here is endogenous instead of just doing something else that's exogenous. Yes, but the result from the spillover just stands if you don't believe in currency mismatch. That's basically what I wanted to highlight. Okay.
So say the same thing probably in a simpler way is that if there is no coordination, countries are going to compete to attract capital. And that means that they're going to raise the interest rate more than what they should.
Exactly.
If there is perfect coordination, do they still raise the interest rate or they don't? Really at the beginning that they decrease interest rate.
So relative to before the shock, you mean? That depends on the model you have in mind.
Right.
Yeah.
Okay.
Yeah. So should I show you this now? Maybe I can show you this now. No. Yeah, I have a link somewhere. Where is it? Okay, maybe go to this. Let me show you this. Okay. So let's do the same model as before, but add something more complicated to it, which is.
You have 20 minutes, by the way.
I have 20 minutes?
Yes.
Plenty of time.
Okay, let's go.
So let's do the same thing as before, but also try to match the paper by Pierre that we talked about in the beginning, which is that these things are there, but we also know that in the data, emerging markets tend to ease the policy rate as a response to US monetary policy. Okay, I'm going to show you that as a from the results. I know it's surprising, but that's the fact. Okay, so why is it? You add a trade channel to the model. That's the easiest way to do this. And the idea is simply that when the Fed is tightening, yes, you have depreciation of your currency, and that's costly, but you also get something that looks like a negative aggregate demand shock in your country. If that's the case, then the optimal monetary response might be to decrease your own interest rate. And you want to lean against that aggregate demand shock. But the thing I want to highlight is that it doesn't mean that you go all the way to closing the output gap. Balance sheet effects are still there. So you might lower the interest rate related to the counterfactual where there is no shock, but you're still lowering the interest rate less than what would be required to close the output gap. So in a sense, your monetary policy is still too restrictive related to the no output gap condition. Okay, so that's going to give you this result here. If this shock is big enough, we're going to lower the interest rate in response to the Fed, and yet I'm still going to get spillovers. Why is that? Because if we were all to reduce our interest rate by even more than what we just did, we would also attract less capital flows, which means that the balance sheet of the intermediary will be less constrained, and our exchange rate will be even more appreciated, which would help us reach an even better trade-off. That's why all these things that are related to the marginal effects of doing this stuff, right? It's not about the absolute level of whether you increase or lower the interest rate. It's about what happens if we all coordinate to lower the interest rate by a little bit more. Okay. That's the result. So that's why you get exactly the same kind of spillovers. Okay. Does that answer the question?
Yeah.
Okay. Now the nice thing about this is that because I have time, I'm going to mention it. One of the results that is very nice in that paper, if you don't know that paper, I mean, you probably know that paper given that you're in Chile, but if you don't know that paper, there is one thing that's very nice. So first, this result is surprising, but then they show that the market rates, okay, so the policy rate is decreasing, but the market rate, so the 3 months government bond rate, actually increases at the same time. Okay? So the interpretation is that they want to, these countries are trying to stimulate the economy, but there is something that prevents them from doing so enough, and so market rates still increase because of the Fed rate, the Fed shock. Okay, you get something like this in that model if you assume something that is quite natural, which is that the dollar shock also increases the friction with gamma. So for this, you actually need to really microphone where this gamma is coming from, and you can do that. It's in the appendix of the paper using some kind of VAR constraint. So the idea here is that when the Fed raises the interest rate, that also creates this kind of risk aversion shocks at the same time. So these intermediaries are less willing to take risk on the balance sheet, which in this model just means that this friction goes up. And so suddenly the wage, because of this taking capital flows that's given, the wage is going to increase even more. Okay, and so you can get the fact that this thing increases because of the shock, even though we are all lowering our interest rate at the same time, and that's the equivalence of market rates increase, even though we are having that. So that all these things are consistent, and you get still the same kind of spillovers happening at the same time. Okay. So if there is no other question, let me go back to macro proof because I stopped. Right, so I stopped here saying if this synchronization is due to dollar debt, then you can still the ex ante policies in moral hazard, which is what I want to do very quickly here, and maybe talk about foreign interventions at the end. What we want to do here, it's very straightforward. You want to tax, being careful, you want to tax dollar debt issuance because everyone is currency mismatch, but actually you want to reduce currency mismatch in a full mode. That's what you want to do. Why do you want to do it? Because if my firms have a smaller currency mismatch, then at time 2, when the Fed, if there is a Fed shock that raises the world interest rate and that depreciates my currency, I don't have to worry about the level of my currency as much as before because that doesn't really change the net worth of my entrepreneurs. So they're not going to be as likely as facing the financial frictions. Now, of course, if I do this, there is a trade-off that is going to be more expensive to finance investment ex ante. And so you can show in these models, assuming rho equals 1, just to make things simpler for the slides, that you want to decrease the amount of debt issued in dollars to equalize two things. So the left side here is the benefits of realizing the monetary policy trade-off. It's easier for me to target aggregate demand exposed, and that's valuable for welfare. But at the same time, it's more expensive for these entrepreneurs to finance the investment in the initial capital stock K1, and that's a cost that is captured by this formula here. And so the one thing that really matters in that formulation is this derivative here, dB1 over dB1 star. So when I discourage issuance in dollars, how much that increases issuance in local debt, in local currency debt, sorry, okay? So here, that's what I was saying. Here in my model, this number is very easy to compute because it really comes from different costs. You're just trying to equalize the cost of issuance in different currencies. In a more complicated model, there are different reasons for why that number might be bigger or smaller, and that's the thing you would like to understand to equalize these two things and try to set macro proof at the optimal level. Okay, that's the idea here. Now, you do get spillovers from doing this. So it's privately optimal from the point of view of one country to discourage issuance in dollars to try to lower the currency mismatch of my firms. The one thing that is more surprising is that creates spillovers to other countries, but positive spillovers. What are the spillovers? If I manage to reduce the amount of debt issued in dollars, that's going to have an impact on the external rates charged by intermediaries in equilibrium next period, only under two conditions. And these are the same conditions as before, rho bigger than 1 and gamma positive, because I need these spillovers to be there for this result to be. So what the intuition is that if I introduce macro proof, I lower the amount of debt in dollars of my firms. They have a currency mismatch that's lower than before. If there is a shock to my currency, I don't have to defend my currency as much as before because the net worth of my entrepreneurs is not that sensitive to the level of the currency anymore. And so I'm not introducing as much congestion in capital flows as before because I'm not trying to attract capital flows at all. So the nice thing here is that macro proof is privately optimal, so you don't need coordination to implement macro-prudential policy, and you get policy spillovers in the sense that you ameliorate the trade-off that all other central banks face in the future.
That they're welfare equivalent, like if you only have the interest rate policy available, or if you have that plus the macro proof, and then are they welfare equivalent?
No, I don't think so.
Which one dominates?
I will need to write it down. I don't know if it's a good question.
No, because there is the literature, like the Timbinger rule, right? So there's Pepe Mendoza and others, like central banks in practice don't want to use one policy for two objectives. They want to do two policies for two objectives, and this paper by Mendoza and others in the AG macro shows that actually that one welfare dominates. Just one policy for two objectives. But it would be interesting to see that here.
Okay, can we talk more about this? Because I actually don't know that literature.
Yeah, sure.
So,
yeah. It would be interesting.
Yeah, I never thought about this. Thank you. That's let me say something that's slightly related to this at the end when I talk about FXI. That maybe that's going in that direction, but that's I need to think about it. Let me just mention that paper here, that recent paper by some people at the IMF, where they actually in the data show that. So first of all, they look at countries that implement that type of policies, and they show that it's really macro-proof in the sense of targeting currency mismatch. That then in the data seems to give the central bank a higher control on inflation and output gap later on, and not capital controls. Okay, so this is very consistent with this idea here. Like what you're trying to do is not taxing capital controls or reducing capital inflows. What you're trying to do is really reducing the currency mismatch, because that's what's costly for the central bank exposed to try to achieve your inflation and output objectives, right? So this is consistent with that. And they also have subjective evidence that this has positive spillovers to other countries, but this is very noisy, so I don't want to put too much weight on this. So let me, I have probably 5 minutes. Let me talk about FXI very quickly, because it's a bit. Do I have 5 minutes? Sorry, how much time do I have?
Oh, 10 minutes.
10 minutes. Okay, perfect. So I might even finish early. So here, tell me if it goes into what you were saying or not, because I actually don't know that literature. But the one reason for why you get such strong inefficiency in that model is that you only have one instrument, right? I only have my policy rate from the point of view of time two, but I have two objectives: the balance sheet effects of my entrepreneurs and the output gap for my households. Okay. So the FXI seems to be really what you want to do, because then you get two instruments and you can completely, decorrelate the use of these two. So you will use FXI to just target the exchange rate. That works with the balance sheet of my entrepreneurs, the net worth, and I solve that problem with FXI. And then I use my interest rate to completely solve the aggregate demand problem. And then I probably can go back to the real first best of my country. Okay, so if you actually want to study this foreign exchange interventions in that setup, you need to add a layer of intervention again. So let me show you, maybe that's going to be easier. So you need to do something like this. I'm going to tell you why, but you need to first assume that there is a different intermediary for each country, and then they all go through the same global arbitrageurs that has access to the Fed. So why do you need to do this? Because if each emerging market is just going directly straight to the global arbitrageur, they will not internalize the fact that their use of reserves will have an impact on the exchange rate. That's also general features of this model. If you want the central bank to internalize the fact that by using reserves, I change the equilibrium exchange rate, I need to internalize the fact that that works through my arbitrageur. And for this, my arbitrageur needs to be specific to me. Otherwise, of course, I don't internalize anything happening on their balance. Okay, that's a technicality, and there are probably other ways to do it. But just to be fully transparent, that's something new. Okay, so if you do this, you get this natural result that if really you have unconstrained reserves, the amount that you have on the balance of the central bank is sufficient, then really you can go back to the constraint efficient equilibrium. I have two instruments, two targets, and then they all do their job. I don't get any involuntary underemployment, and so I don't get any spillovers, because the wage rigidity is not binding anymore, and so it's not costly for countries to have an effect on each other.
Is it costly to issue with stock money reserves here?
I'm not talking about this for now yet.
Yes.
So for now, it's like I'm at period 2. I have an amount of reserve. Is that amount of reserve enough or no? That's the first question. And then we can go back to how costly it is to issue reserves. Actually, it's not in that paper, but we can, yes. So now it's really like the shock hits. Do I have enough reserves to stabilize my currency or not? If I have enough reserves to do it, great. If I don't have enough reserves, then it's slightly more complicated. You still want to use them, right? Because it just helps you to appreciate your currency, and that's very useful, because then it releases the pressure on the aggregate demand channel for the central bank. So you still get some kind of underemployment, which is another way of saying reserves are constrained. I cannot go all the way to zero output gap. All the currencies are more appreciated, and actually FXI have policy spillovers across countries here. Okay, so what is the reason? I use my reserves to appreciate my currency. That means my interest rate is not trying to appreciate the currency at the same time. So the interest rate is not trying to attract capital flows, and that releases the pressure on the balance sheet of the intermediary, and that's good for everyone. Okay, so you do get positive spillover across countries, which is somewhat a new result, because in other models you get the opposite, and we can talk about why. Now, what is the other type of result that probably is more interesting, because this is quite intuitive, is that if you use your reserves in response to this type of depreciation of your currency, of course, in equilibrium, you're going to have a currency that's more appreciated than if you're not using reserves. What does that mean? It means that your own corporations at time one, when they decide how much to issue in dollars or in peso, they take that into account. So they know that in past states of the world, the currency is actually going to be more appreciated, and that gives you even more incentive to issue in dollars. So you get the more hazard channel, even more if you actually use reserve than if you just use the interest rate. And that can go as far as lowering welfare, in the sense that I expect the central bank to help me so much appreciate the currency in the future that I actually want to issue so much more in dollar debt that the problem of the central bank is going to be even worse ex post, just because balance sheet effects are going to be more stronger. Does that go into the direction of the paper you were mentioning?
No, I mean, definitely this speaks to the cost of a second policy, which is a fixed side, right?
Okay.
But the point is, you have two policies where it's always the interest rate, and then on top of that, you have either FXI or macro Q or whatever other alternative, like tax on capital flows.
Mhm.
Then what is the welfare, the optimal welfare of those two policies compared to the optimal welfare of only using one policy?
Okay.
That's
So,
like my
yeah,
maybe
so
a bit
here-
picture.
So here that you get this, which is sometimes having two instruments, reserves and monetary policy, makes it worse. That's because there's more other channel
Mhm.
that's there. But that's true only if you have access to reserves that are also constrained. Okay, so there is some kind of linearity here. If I will have access to reserves, to some amount of reserve that's not too big, then it's going to be costly in terms of welfare because of moral hazard. If I can actually build such big buffer of reserves, then I will not have to worry about aggregate demand in the future. Then I go back to the point where it's welfare improving to have that big stock. And then you need to add the cost of issuing reserves, and that's not in that more, but that adds.
So I have a very basic question,
Yeah.
probably, again, out of my ignorance. If the original sin is currency mismatch,
Mhm.
shouldn't we encourage exchanging rate insurance? And that will solve everything.
We should encourage what, sorry?
Insurance?
Oh, yeah. Yeah. So what you really want to do is lower the currency mismatch of your corporation by hedging. And that's exactly what you want to do. Yes.
So in Chile,
But sometimes you don't want to. That's the point of the variable paper.
Sometimes you don't. Why is that?
Sometimes it's optimal for the firm to have the currency exposure because it correlates with the investment opportunities.
So it
So
could.
in some cases, it's optimal for
So-
the firm. For some firms, for some.
Sorry, let me add something here. It is privately optimal for the firms in that moment too to issue dollars. It is privately optimal. The problem is that it's not socially optimal. The socially optimal level of dollar debt issuance is lower than the privately optimal one. That's my point here.
Also, hedging is costly, no? Taking your
It's
hedge.
very costly.
Hedging
So
is
we
very
should-
costly.
so we should subsidize hedging. Is that the,
I'm not sure.
okay, never mind.
I don't know if you
We
want
can talk later.
If hedging is costly because just the market is not developed enough, then you want to encourage development of a market that's going to offer cheaper hedging alternatives. I think
Yeah.
that's something that in any mode will give you like a welfare improvement, right?
Okay, yeah, yeah, sure.
Yeah, and here it will be even bigger because of this
This all the things.
all
Okay.
these other things. But that's just general.
Okay.
A general statement. Okay, so that's the FXI results. Let me just conclude. There are other extension in the paper, but these are the ones that are the most important ones. So just to like 3 bullet points of what I think on the contribution of that model is this new bottleneck externality that really works through the balance sheet of these intermediaries. Why I think that's important, just because everyone uses this type of intermediary now, and you know the welfare implication of these things has been a bit overlooked, and that paper is trying to go into that direction here. Okay. So the DFC is inefficient in that case and it requires coordination. One way to get away from that coordination problem is to use macroprudential policy that has positive trade-off between countries. But if you actually also want to use FXI, then you need even stronger macro ex ante. I think that's the 3 main things of it. Thank you very much for the comments and looking forward to talk even more after that. Thanks.
Thank you so much. Question? Very good. Are you hungry?
Yes.
Go for lunch?
Yes.
No, vale, sí. No, reunión de escuela.
No. People were
You see what it says?
very close.
Point of the gap.
Court?
I don't say.
I mean, we make tennis.
No. You know my wife. My wife, very good credit.
Yeah.